So for today's trade of the day on the 23rd of December, we're going to explore one of the sort of biggest problems a lot of traders have when it comes to swing trading, and that is really about staying in trades. So once you're in a trade for 2, 3 days, after that, that psychology, those emotions can start to kick in a little bit, and we start to, if we're not already out of the trade, we're worried about it coming back and so on. And the reason why is that the markets can flip-flop around quite a lot. If you kind of think about swing trading compared to intraday, I always go on this basis that the market will carry on in its existing direction until new information comes to light. Now, on a 2 minute chart, not much new information is coming out on a 10, 20, 30 minute basis. So, holding for those longer moves in candlestick, number of candlestick terms, it's actually a little bit easier. When it comes to swing trading, there's new information coming out most days, right, that could move the market back around. So when you look at a particular bar like this one, it went up to here and then down to here and then up and down and up and down. This movement here feels relatively smooth, but actually in reality, that movement from there up to there, that's about 100 pips. And then down again, and then up, down, up, down, up, down, up, down. It's actually flip-flopping around quite a bit. Now, what you have to do is, if you're going to swing trade, is look at it in one of two ways. One, you've got to allow that to take place and just try not stress about it. But actually, in most cases, a lot of traders find that quite difficult. So what you're going to do is you're going to look at that momentum and you look to get out of the market before it starts to flip-flop around, and before that sort of almost anxiety starts to kick in a little bit, that impatience starts to kick in. So from my perspective, we shouldn't really be worried about trying to make 3, 4, 500 point moves because they're very hard to stay in on that basis. But what if we can just take that short-term burst of move out of a market, that momentum, before new information comes to light and before the market has an opportunity to start to spin back around? Okay, so that's really the basis for the D1 accelerator strategy. Now, it's trading on the daily charts. We're just putting those trades on once a day. It's pretty straightforward. There's an entry there from Friday's close, 20th of December there at 97.73 or so. Now, what you're seeing is your market that's already moved up 30, 40 points, and that's really what we're looking for. 30, 40, 50 point, that kind of sweet spot there is a great move. And you're looking at that, well, look, market's moving up. Let's allow it to keep moving up. Let's take our profits before it can flip-flop back again, and we'll move on. And we move on with a bigger account than we had when we started, and that allows our account to compound and grow quite actively because, if you're taking profits, even if it's in this case around sort of 1%, your account's now 1% bigger than it was. And what that means is your next trade size can be 1% bigger than the previous one. And of course, that compounding allows you to grow and scale that account faster. The other thing that it allows, the more active approach is a smoother equity curve, tighter stops. Those targets there as well, tighter targets, tighter stops, means we're going to be in and out of trades more effectively. It means tighter equity curve. It means lower drawdowns. Is that more active approach, being able to more nimbly exit. I mean, even if you look at this opportunity here, it may not be the best reward to risk in the world, but you know what? It made those 30 points real quick before the market then flipped around. So it's a small winner. It's a bit like betting on the favorite in the horses, right? It may not be the best payout in the world, but you know what? It did it. Hit the target, stopped, span around on a sixpence, gave us a buy, and here we are. Taking profits on this opportunity as well. So it's really about, this video is about having that understanding of how these markets actually operate, and really what you need is a strategy that is according to that. And that is a very different thing to what a lot of people think about the market. A lot of people say that the purists will tell you that you've got to trade in this, and this way, and it sounds good in theory. There's a lot of stuff that sounds very, very good in theory. Of course, we should be doing that and this, that, and the other. But in practice, doesn't really pan out. A lot of that is down to that psychology that we have, and really nice smooth equity curves that we want as well. So looking at that short-term boost of momentum, looking at exiting those trades before they have an opportunity to flip back the other way, will smooth our equity curve. It'll allow us to grow our account faster, and actually it will allow us to profit from the way these markets actually move rather than how a lot of people perceive them or think they move.
Want to learn how to find profitable trades like this? Register for our free trading webinar and discover the strategies that turn you into a confident trader. Prefer a more hands-on approach? Schedule a one-to-one walkthrough with a senior trader. See our software in action and get those questions answered, and take control of your trading journey.